Hi, David.
Hi, John.
I'm a little confused. I mean, you're an expert, and there's so many experts, and they're calling gold at 3,000, 4,000 already. It should have come to pass. How could so many people get it so totally wrong?
Well, are you thinking about the price in particular, or what element do you think is wrong?
Well, I'm thinking about the price. It's what $12.99 today. A lot of commentators were saying, gold is going to skyrocket. We're going to have massive inflation, and the velocity of money just is not there because the money is not getting into the economy, so there is no velocity. Who's to say that there will be velocity? If interest rates rise, house sales will go, the average selling price will go down. People won't be getting loans for houses. There won't be, money going into the economy.
Well, John, I think at the heart of the question is what every expert should be cautious with is attaching both price projections and time frames in the same sentence or the same paragraph or same research paper, because what you have a very legitimate criticism. What I would say is that we haven't hit a time frame in which it has happened. I mean, I think if you were able to sort of transport yourself in time 20 years forward and look back, then with great accuracy you could say, how were they all wrong? But we haven't finished this cycle yet. I mean, we're still sort of in the middle of the game, and anyone who's calling for how the game ends when you're still in the middle of play, squarely, second, third quarter, it's really difficult to say who is going to be able to call the game in the middle of the game, who was right, who wasn't right. I wouldn't be critical of anyone calling a price at higher levels unless they were attaching a specific time frame to it. I mean, for instance, $3,000 by the end of this year. Well, maybe it is, maybe it isn't. But we could see 3,000 over the next 24 to 36 months, a much broader time frame in which a set of circumstances which can drive the price to those levels can play themselves out.
Yeah, I understand what you're saying, Dave, but what I'm saying, and I'm not trying to be a devil's advocate here, is I've heard so many explanations of, why it's going to happen in a time frame that's already passed. I mean, even when, gold was at 1900 and silver was at 48, people are saying silver's going to 75, and they were talking about a soon time frame. They weren't talking about, 3 and 4 and 5 years. I mean, because, is there so much market manipulation here, or is it something else in play?
Well, I think one of the things that you have in discussing gold and silver is what gold and silver represent to the establishment, and there is a good reason for there to be, and this isn't conspiracy theory. This is just simply, the fact that central bankers have never liked something that is a telltale for how well or not well their policies are working in the marketplace. It either speaks to their legitimacy or it delegitimizes their activity in the marketplace. And so, to assume that we're in sort of a neutral world where gold and silver will be able to just go where they want to go in terms of price without something of a fight, right now we're dealing with nothing more than a PR campaign. There's nothing substantive driving the price of gold and silver down today, except listening to the mass media suggest that we're in a bear market and you should get out if you haven't gotten out. What's fascinating is none of those people participated in the gains from 300 higher, nor will they participate as it goes higher still. But there is an effective campaign to delegitimize gold and silver in a portfolio. Because again, it's the only thing today that gives testimony, that gives testament to the illegitimacy of Fed monetary policy, ECB policy, Bank of Japan policy, et cetera, et cetera.
One last point, and then I'll let someone else get in.
Mm-hmm.
I understand what you're saying, and what I would say is I hear different stories. I hear stories like the bankers are selling their gold to the east, to China and India, and there's going to be no more gold left in the United States. And then I also hear at the same time that the bankers are, switching positions, and instead of being massively short, they're going massively long. Are you hearing the same stuff?
Bankers are always looking to make a buck, and however they can, they will, whether it's long or short. I don't really think that the bankers have as much interest in this as sort of our monetary authorities and the Treasury. Let's look at something that I think is pretty critical. When the market collapsed in 2007 to 2009, there was a $9.2 trillion loss in values. If you're looking at the total market cap of U.S. equities, lost $9.2 trillion. Now, since then, we have had our national debt. Just remember that number, $9.2 trillion.
Okay.
Since then, we've had our national debt increase by $8 trillion, and we've had the Fed balance sheet increase by $2.6 trillion. So essentially, we have corrupted the Fed balance sheet and put the next generation in hawk in order to replace the lost value in equities. We've completely destroyed our national balance sheet to do that. The long-term sustainable trend of the dollar, respectability of the dollar in the world monetary system is more in question today at the end of this debt binge and Fed balance sheet expansion than ever before. Meanwhile, what we are told to look at by the mass media is what? The very impressive 14,000 and change, 15,000 and change number on the Dow. And that is supposed to tell us that somehow the economy is healthy. Meanwhile, the only way we have that number in play is because the government was willing to create the impression of health in the stock market and hopefully convey from stock market to sort of have people cross-reference that and say it must be the case that the economy is also recovered. And this is where we find ourselves. Again, why is there a bias against gold and silver? And why should we expect there to be something of a PR campaign against it? But ultimately, I think this loses. I mean, we saw the same thing happen in the mid-'70s, the same sort of negative PR campaign from 74 to 76. So these are just old tactics. The IMF used to do this on a regular basis, trying to beat up the price of gold. Why? Because on the other side of the equation is the need for people to believe the recovery story. And if you don't believe the recovery story, then everything that they're doing to create this sense of recovery falls flat. And in fact, it is falling flat. I mean, that's the reality. But where do we see gold today? $12.99. Where do we see gold going? The free market, ultimately, and I think individuals like you, individuals like me, individuals all throughout the world say, you know what, this is just a bad idea. The amount of money that is being created, in spite of a drop in velocity, as you note, in spite of a drop in velocity, this is not good. Because let's look at the money multiplier. Velocity is one factor, but let's look at the money multiplier. We now have M2 sitting at around $10 trillion. With a normal money multiplier in play, let's go back to the 2008 time frame, you're talking about really a monetary footprint not of 10 trillion, but of closer to 30, maybe even 40 trillion dollars. So I mean, when we comfortably say there is no inflation today, people should be aware that all you're dealing with is a trigger in the marketplace which takes the liquidity which has already been created and turns it from benign inflation or no inflation to super or hyperinflation. We have everything in place for a superinflation today. All you need is a trigger. And usually people start spending money on two bases. One, because they believe that the economy is in recovery and they can afford to spend it. Or two, they believe the value of the currency in question is so unstable that they better spend what they have while they can. And that secondary thing is really the stage of inflation that I think we are moving towards, where you will see an increase in the velocity of money. And at the same time, it'll have that element of 1970s sort of stagflation, because we're not seeing an increase in incomes.
Right.
So you've got people stuck between rising prices, and yes, they will try to get out of their cash position. But again, that's sort of a second stage of inflation, and something that we've already probably started into.
Well, thank you, David.
Thank you, John.
Thank you. Moving out a little bit to your 2013, 2014, whatever, what is an economic circumstance that would speak to you of a sell? And has your company ever named a time that, it'd be good to sell, or has it been to buy ever since you've been in business?
Good question, Mary Ellen. On both fronts, one, what would the circumstances be in a 2013 to 2014 time frame, and also, are our recommendations static in nature? Let's start with the first, because it is a little bit more macro. 2013 to 2014, there's a number of things. One, what is happening in the bond market, and another, what is happening in the currency market, which would drive concerns. People who are today on the sidelines sitting in cash or in short-term treasuries and consider that to be a safe position, ultimately, why would they leave that position and consider gold and silver? And basically, have we run out of buyers? I mean, at what point do you see the masses buying gold and silver and pushing them to a place where it's unsustainable? Why is it unsustainable? Ultimately, you're dealing with just what drives any market. You have to have a stock of buyers who continue to come in and drive the price higher. If you run out of buyers, the price is going lower. And today, when you look at that equation, it's pretty interesting, because your commercial interests, who normally hedge their production, in other words, they're short in the market and they're not buying long because they're producing the stuff and drawing it out of the ground, they're not hedging. And so your short positions from commercials are at the lowest position we've seen since 2005. On the other hand, your speculative interests, and again, I'm talking about the futures market here primarily, but your speculators, you've got the smallest amount of people in the gold market today. If you're looking at long positions, it's actually lower now than it was at the lows of 2008. What's encouraging to me is that these are all people who are potential buyers. If you need to know who the stock of buyers is and whether or not you've run out or have lots of people who can join the queue, join the line, your speculative interest in the futures market has the potential to swell considerably. On the other side of that equation is your speculators who are short the market, and they're expecting gold prices to go lower. You're talking about speculative shorts at levels we haven't seen in decades. And again, why is that positive? Why is that encouraging? Because whenever you see a spike in speculative short positions, that usually is a precursor to a major move higher in gold. 2008 and 2005, just as two recent examples, you saw the speculative short interests rise, and ultimately those shorts had to cover their interests, come into the market, and become buyers to close out their short bet. And they became buyers. So I'm looking at a short position, which is the largest we've seen in decades in the gold space. That's a stock of buyers ready to join the queue, so to say. The long interest is the smallest we've seen since the lows of 2008. You have no headwinds from the commercial space. I mean, these are, what I'm saying is you have, at least in the U.S. market, a huge number of people who can, and I think ultimately will, come into the gold market and drive the price higher. To your concern and to your question, Mary Ellen, is the notion of what brings us 2013 to 2014 to a point where we would want to sell. We need to be at a point of exhaustion. We need to see the gold and silver price go as high as it can go and not be able to go any further. And that's why I bring it back to that basic issue of demand. We don't have a huge increase in supply in the metals. So in this case, the real critical variable is the demand variable. And so who's in the market, who's going to be in the market, that I think ultimately defines when the market is exhausted and can go no further. But I think there's circumstances which drive investor interest into gold, and that's why I mention particularly the dollar market, which up until 2 days ago was breaking all levels of support. We broke through the 50-day, the 200-day, the 100-day moving average on the dollar. Since then, we've recovered the 200-day moving average. This is all technical, of course, but I think the long-term trend and trajectory of the dollar is 20 to 30% lower at a minimum. And again, you put yourself in the position of the average household. Can you pay your bills if your current income buys you 20 to 30% less? Does that make sense? I mean,
yeah.
Or the other side of the equation is, if everything that you're buying today costs 20 to 30 or 40% more tomorrow, do you have the money to go out and pay for it? And when people's concern about dollar stability is in play, you begin to see a mass exodus from the currency and a move into gold and silver particularly. The reason I mention the Treasury market, and I think this is worth mentioning particularly this week, this is one of the most critical things that happened this week. Okay, price of gold and silver moved lower. Far more significant than the volatility. This is probably the most important thing I could share with you tonight. Far more significant than the volatility in the gold market and silver market this week was watching what the Fed did in terms of the 10-year Treasury market, in terms of the mortgage-backed securities market. And if you have a pen, you'll want to write this down. The 10-year Treasury over the last 8 weeks has gone from 1.66%, to 2.51%. This is a greater than 50% increase, in the 10-year Treasury note. And why is that important? Rates are rising. This is what I want to share with you that's absolutely critical. The Federal Reserve this week bought just shy of $55 billion worth of treasuries and mortgage-backed securities. And in spite of what was a massive purchase in the Treasury market, rates were moving higher aggressively. In other words, there was no market for treasuries. Nobody wanted to own them. There was a massive dumping of treasuries and mortgage-backed securities this week, and the only reason we didn't see the 10-year spike to 3% was because the Fed was involved and intervening, and again, a $54.7 billion footprint. That's this week's purchases in order to smooth over what is a massive volatility in the interest rate market. As goes interest rates, so goes the equity market, so goes our ability to finance our deficits, so goes our national solvency and ultimately the stability of the dollar. I mean, this week, I think, was absolutely critical to understanding the direction we are going over the next 2 to 3 years. And Mary Ellen, so what takes us to a level where we would want to sell gold and silver? This kind of trend playing itself out and continuing as people say, we're just not interested in owning treasuries anymore. That's what we saw this week.
I've been in gold and silver since 1966. That's a pretty long time. And I've never really heard a sell signal. And if gold and silver is really considered cash, you just have to move with the ups and downs of it. I don't know that there really is an economic scenario that you could describe or anyone could describe to tell us to sell, because there's different reasons for keeping it. But just recently, and I don't know if you can address this, I've always looked at inflation being the picture ahead. But when you see what is going to take place in this country with the banks, with foreclosures, and money not being put into, the gross national product, all that coming down. For the first time, I see possibility of deflation. And if there were deflation, with everything you've described, I can see that possibility. What would you do then with gold and silver? I think you still have to sit on it.
Well, let's look at that from two vantage points. Number one is getting to your second question. Your second question is, are our recommendations static, or would we suggest selling gold at some point? I think what I would say is that I would never sell all of my gold or silver. I would sell a portion of it, And it would only be to move into other assets that I would consider to be such a compelling value that, as you, Mary Ellen,
right.
you said it so clearly, gold is money. Gold is money. And when the world goes on sale, when your purchasing power goes crazy, it's important that you put some of that money to work for you. It's important that you move out of your cash position, quote unquote, and move into other assets, whether that's real estate, stocks, bonds, private business interests, or what have you. It is important to make that transition. But it's also important to realize that you don't get rid of all of your money. So, yes, there is a time that we think that makes sense. There's also a way, and I would say in terms of the sort of static nature, we will regularly recommend to clients to sell this to buy that. And let me give you an example. Junk silver today. Junk silver today, if you're liquidating junk silver today, it carries up to an 8% premium over just the raw silver content. If
Right.
you happen to have half dollars, they can sell for as much as 16%, depending on the day and the quantities, et cetera. But the premium on that product, frankly, someone else can own that product. And I would rather take the extra 8 or 10 or 16% and put it into something else. I'd rather capture that premium and put it into other products. So, while we may sit on quote-unquote money, gold and silver, it's not as if there's nothing to do along the way. Being in business for 40 years, the nuanced nature of the precious metals market, looking for opportunities, I can tell you there's some of the most compelling opportunities on the planet today in the gold and silver space. I mean, things that are just ridiculously compelling in terms of value. And then there's a few things, like junk silver, which I just mentioned, I would not be a buyer. I would be a seller. Why? Because that's the premium I want to keep, and I'd like to capture it, which requires me making some sort of a shift in the portfolio. Now, back to your last question. This is really critical because what you mentioned about deflation, keep in mind that we have seen massive increases in leverage within the financial system. This is normal. And we've had, you go back to the depressions, the panics, and the deflations of yesteryear, the panic of 1825, the panic of 1873, the panic of 1929 to 33. These are environments where, there was too much leverage in the system. Mm-hmm. Banks had been making too many bad bets, and ultimately there was a comeuppance. Guess what the one difference is between now and that period of 1825, 73, or closer to us, and our remembrance is 29 to 33, 1929 to 1933. Unlike those earlier cycles, we now can create an unlimited amount of credit, an unlimited amount of money to fight a debt deflation. We have the gearing in the world's central banks to print and print and print, not like Haberstein did in Germany, where he was limited by physicality. He was limited by the amount of trees that could be cut down, turned into paper pulp, and have ink printed on them. there was still a physical process of printing. We don't have that today. In the digital era, we can create trillions of dollars out of nothing in nanoseconds. That's a dangerous place to be, but it's also, from an inflationary standpoint, but it also means that there's no amount of debt implosion which can't be compensated for by just adding a zero to the equation, or 2 zeros, or 10 zeros to the equation. So different than all of our past debt or debt deflation implosions is the fact that we have gearing in place today which would tend to take us in the direction of inflation.
I hear you.
Hopefully that helps, Miriam.
Thank you.
Uh-huh.